And I'm also an editorial board member of the Visnik of the National Bank. As Deputy Governor Rashkovan already said earlier today, the National Bank would like to make its decision based on analytics, based on research. So in 2015, the National Bank of Ukraine also has been trying to improve its research capacity, and as part of that has revamped its academic publication, the Herald of the National Bank of Ukraine. So I would like to invite all of you to go to the website of the National Bank, to go to the publication section, and then take a look at the latest research by the researchers of the National Bank and by some other Ukrainian researchers. Very highly recommended. The panels so far, the research panels so far, have been very much focused on core issues of the work of the central bank. It has been on monetary policy, on inflation, on macroprudential policy. As this fifth panel will illustrate, the researchers at the National Bank and the National Bank needs to have a wider view, needs to have a broad view of the economy. And hence, researchers at the National Bank do research on all kinds of topics, also not very narrow central bank topics. And this fifth panel that we have today here illustrates that very well. As you can see, we have Marianna Kudlyak, who is a senior economist at the Federal Reserve Bank of San Francisco, and who is also, happens also to be an alumni of Kyiv School of Economics. And she will talk about unemployment and how to measure resource allocation and unemployment. Then we will have Yuliya Demyanyk, who is a senior economist at the Federal Reserve Bank of Cleveland, and also happens to be an alumni of Kyiv School of Economics. And she will talk about debts and how more debt sometimes might be good. And then finally we have Iikka Korhonen, who is the head of BOFIT, the research center of the Bank of Finland, whom we would like to have had as an alumni of the Kyiv School of Economics, but he has been a faculty member instead. And he will talk about how China influences the world and how China's economy evolves with the rest of the world. And so we will end with how China influences or will influence all of us. The format of our panel is similar to the other research panels. We will have 20-25 minutes of presentations of each paper, and then 5 minutes for discussions and questions. Okay? The floor is all yours.
Thank you, Tom. Good afternoon, ladies and gentlemen. It's a great honor and a great pleasure to be here. It's an impressive conference, the speakers, the audience, the level of organization. So thank you so much for putting our paper on the program. So I'm going to present the joint work with Andreas Hornstein, who is at the Federal Reserve Bank of Richmond, and Fabien Languet, who is at McGill University in Canada. And as usual, the disclaimer applies. The views expressed here are only of the authors and should not be interpreted as views of the Federal Reserve Bank of Richmond, the Federal Reserve Bank of San Francisco, or the Federal Reserve System. Okay, so yesterday and today, we talked about the mandate of the central bank. The Fed has dual mandate: price stability and full potential employment. And one of the key components here is measurement. And yesterday the governor and today deputy governor talked about data. And so what we do in this project, we bring the micro data to answer macro questions more so than it has been done before. Okay? So in this paper, we'll be measuring the resource utilization in the labor market. So let me start with defining the key concepts as they relate to the measurement of resource utilization in the US labor market. So every month, the Bureau of Labor Statistics conducts a survey, current population survey. That is a survey of 60,000 households, and there are battery of questions as they relate to the labor market, whether the questions are whether individuals are employed, and if they are not employed, what they do to find work. And every individual in the civilian non-institutionalized population, 16 years and older, is classified in one of the three labor statuses: employed, unemployed, or out of the labor force. So employed are those who have work, who have job. And then everybody else is non-employed. Among the non-employed, we distinguish those who actively search for work and are available for work. And also those who are temporarily out of job and are waiting to be recalled, they don't need to be actively searching for work to be counted as unemployed. So unemployed are only a part of the non-employed. Everybody else is considered out of the labor force. Why is it important? Because when we construct a measure of how much labor resources are there in the market, we only count those unemployed. So the measures of resource utilization in the labor market are as follows. The labor force is the sum of the employed and the unemployed. The labor force participation rate is the labor force as a percent of all civilian non-institutionalized population. And the key measure of resource utilization in the labor market is the unemployment rate. It's a share of unemployed as a share of labor force, okay? And so, especially after the 2007-2009 recession, the questions that we are dealing with is whether unemployment rate adequately measures labor resources in the labor market. And let me explain why. So, on this figure, we have two lines, the blue line and the red line, okay? The blue line is the unemployment rate. So unemployment rate exhibits cyclical fluctuations, increasing in recessions and declining during recoveries. So during 2007-2009 recession, the unemployment rate reached 10%. And since 2010 to 2016, it declined from 10% to 5%, okay? And so when you look at the unemployment rate, it shows that economy is on its full recovery path. However, at the same time, what was happening, the number of workers who are neither employed nor unemployed have been growing, okay? And so the red line here shows labor force participation rate. It reached its peak in 2000 at 67% and has been declining ever since. And actually the decline accelerated in 2007. So from 2007 to 2016, the labor force participation rate declined from 66 to 63%. And so many wonder whether the unemployment rate adequately measures how many labor resources are out there, okay? And so the questions that we would like to answer in this project is, post-2007, is there a substantial resource underutilization in the US labor market beyond what is measured by the standard unemployment rate? Okay? And so to this end, I'm going to talk, the structure of the talk will be as follows. First, I will briefly give you a definition of the alternative measures that we propose. Then I'll explain how we construct that measure, which we call the non-employment index. And then I'll show you the results, how our non-employment index compares to the standard unemployment rate. Okay, so we construct the non-employment index. And I will not have any formulas here, but that will be the definitions that I have. The non-employment index counts all non-employed, but gives different weight to different groups of the non-employed, okay? And so the weights here are supposed to reflect the labor market attachment of different groups of non-employed. And we measure labor market attachment by the group's propensity to become employed in next months. And then the weight will be that group propensity to become employed as compared to the group with the highest propensity to become employed. So the group with the highest propensity, that I will show you in a moment, for example, short-term unemployed, will have a weight of 1. All other groups will have a weight less than 1, okay? And when we construct the index, we will keep weights constant, so we will use some sample average, and the only component of the index that will change will be the number of individuals in each group, okay? And so those of you who are familiar with Bureau of Labor Statistics series might know that Bureau of Labor Statistics already releases alternative measures of resource utilization. So how our measure differs from those. So Bureau of Labor Statistics, in addition to releasing the standard unemployment rate, sometimes they call it U3, also releases U4, U5, and U6. So those measures selectively add certain subgroups of non-employed individuals from the out of labor force, and everyone is added with the same weight 1. We will be adding everyone, and we will be assigning different weights, and I will talk a little bit more. Okay? So let me talk about the construction of the non-employment index. So as I mentioned, the Bureau of Labor Statistics conducts the survey every month. And that survey, its current population survey, it's available publicly. The micro data from the survey is available publicly, so everybody can go and download and play with the data. So what we do, we employ 2 different classifications of the non-employed into groups according to the degree of labor attachment of different groups. So one classification will be using information only from 1 month's survey. An alternative classification will be using information from the 3 consecutive months. So why do we have those 2 different classifications? So first, we argue that classification based on 3 months data better reflects the labor force attachment of different groups. Okay? Also, that classification allows us to cover longer time series. At the same time, it's much easier to replicate the classification based on 1 month. So I'll be showing you 2 alternative classifications, but the message will be very similar. Okay, so let me start first with the first classification, where we use 1 month's information from the current population survey to construct the non-employment index. So we look at all non-employed, and we classified all non-employed into 9 groups. So there will be 2 groups among the unemployed, short-term unemployed and long-term unemployed, and there will be 7 groups among those out of the labor force. So in the current population survey, there are a battery of questions. Let's say if a person is classified as out of the labor force, there are a battery of questions whether what this person did in the recent year. And so there is a question whether the person wants job or don't want job. And among those who don't want job, we can distinguish between retired, disabled, those in school, and those who don't want job, but they're neither retired, nor disabled, nor in school. And then there is those who say they want job. And among them, we can distinguish those who are discouraged. For example, they're not actively searching for work now, but they did work or searched for job in the last 12 months. And they say they are no longer searching because they are discouraged, because either their skill no longer needed in the labor market, or they're being discriminated against because of age, and so on. Okay? So if you look at these 9 groups, you can anticipate that there is a different propensity to become employed for those who are short-term unemployed versus those who are, for example, retired. So our index will take that into account. So let me now show the transition probabilities for each of the 9 groups. Okay, so here we have the monthly transition probability. Actually, it's annual averages of monthly transition probabilities to become employed by those groups that I've shown you. So the black line shows transition probability for short-term unemployed. So on average, 30% to become employed next period. Then there are 4 lines bunched together. There's long-term unemployed, and those 3 groups who are not officially counted as unemployed, but they say they want job. So as you can see, they have very similar transition probability to become employed. Long-term unemployed, and those who are out of the labor force, but say that they want a job. And the lowest transition probability is those who are out of the labor force, they say don't want job, and they're either disabled or retired. So our index takes into account these different transition probabilities. So the group with the highest transition probability, the short-term unemployed, will enter index with weight 1. Everybody else will enter the index with weight less than 1. Okay? So this is the classification based on 1 month's information. And as I mentioned, we have an alternative classification where we use 3 months information from the current population survey. So this classification is based on my work with Fabienne Languet, where we argue that it's very easy, instead of using just 1 month's data, to use 3 months' data, but you get much more information about the person's likelihood to become employed in next month. So let me just explain a little bit more. So traditionally, we think about current population survey as a cross-sectional data because it covers large cross-section. However, as a current population survey, it has a panel dimension. And so here I am trying to show you how the survey is structured. So each individual is interviewed for consecutive months. So in months 1, 2, 3, 4. Then the individual is not interviewed for 8 months. And then he or she is again interviewed for consecutive months. Okay? So in each month, there are a battery of questions about labor market attachment. So in each month, we can construct the labor force status. This S1, S2, those are labor force statuses. Okay? So we will be using these 4 months panels to construct the history of labor force statuses. Okay? So we will define the groups of non-employed based on their histories. And so in month 3, we will have 3 months history. So why we are looking at 3 months versus 4? Because then we want to construct the probability of transitioning from the history into employment in month 4. And we are focusing on those histories that end in non-employment in month 3. So I is those out of the labor force, inactive, and U is unemployed. There are 18 histories like this, and we can construct the probability of transitioning from month 3 to employment in month 4, conditional on the history. So there are 18 histories, and what we do here, we argue that we can aggregate 18 histories into 6 broad groups. The idea is that individuals within group have the same transition probability into employment, but across groups sufficiently different. And so we define 6 groups, 3 groups that in month 3 have unemployment, and 3 groups that in month 3 have out of the labor force. So among those that end in unemployment in month 3, first group we call it U recent E. So unemployed in month 3, but had recent employment, either in months 1 or 2. Then U, so those who are non-employed and report active search in every month. And there is a precise definition of what it means to actively searching for work. And finally, the third group would be those who are unemployed, they didn't have a job in the previous 2 months, and they are circling between out of labor force and unemployment. Okay? So similarly for those out of the labor force. Now let me show you how the probability to find a job looks by those 6 groups. Okay? So here we have 6 transition probability, 6 lines. Each line corresponds to the monthly transition probability conditional on the history. The black or gray lines are those histories that end in unemployment. The red lines are those histories that end in out of the labor force. So the highest transition probability, the highest line belongs to those U recent E. So unemployed, recently employed. So basically recent employment predicts future employment. The second line is actually out of the labor force in month 3, but recently employed. And if you want to see how the transition probability to employment of those traditionally defined as unemployed compares, so this is the blue line, okay? So those out of the labor force that are not counted in the official statistics, but they have rather high transition probability into employment. So our index will be taking into account all the non-employed, and we'll be weighting them by propensity to become employed. Okay, so those are the transition probabilities, and let me show you how many of the guys in each group we have as share of the population. So the largest group among the non-employed are those who are OLF, OLF, OLF. So in 3 months, they are out of the labor force. Think about, let's say, retired, disabled. On the right hand, you see the scale on the right-hand side, and they are numerous groups. They are 34% of the population, okay? And you can see that what you've seen before, labor force participation rate, so here you pretty much see the mirror image of that. The rest, 5 groups, they are here on the left axis. The red line at the top, those OLF, recent E, and the rest is at the bottom, okay? So again, to construct the index, we aggregate all 6 lines, and each enters with weight, which is the relative transition probability relative to the group with the highest transition probability. Okay? Okay, again, so here are 2 classifications. The data available for the first classification is 1994 to 2016 because of the major redesign of the CPS. And the classification based on histories, we can go all the way to 1976. And then there is working part-time for economic reasons. So if I have time, I'll go back to this. So now let me show you how our non-employment index looks. So here we have two panels. The top panel shows the unemployment rates. The official unemployment rate is black line, and the blue lines are those U5 and U6. U6 is above, and U5 is close to black line. So U6 counts not only selected group from the out of the labor force, but it also counts those working part-time for economic reasons. So basically workers who are working, but they work in part-time and report that they would like to work full-time, but they either cannot find full-time job or their shift was diminished. So the top panel are existing BLS measures of resource utilization. The bottom panel are those non-employment indices that we just constructed. The green lines show the non-employment indices constructed based on labor force status histories for 3 months. So they go all the way to 1976. And the red lines, those constructed using just 1 month's information. And again, there are two lines because one includes working part-time for economic reasons and the other doesn't. So just looking at this figure, you see that both the official indices and the ones that we construct, they increase in recessions and decline during recoveries. So we would like to compare, so qualitatively, it looks, they are pretty comparable. So we would like to have the quantitative comparison, okay? But the indices are on different scales because unemployment rate, it's unemployment rate as a share of labor force. Our non-employment index is just aggregation. So it's an index that aggregates shares of population in different groups. And so if you want to remember just one figure from this presentation, this next one will be the one. So this one. So what we do here, we want to bring to one scale unemployment rate and our non-employment index. So on y-axis, we have the unemployment rate, the official unemployment rate, or U3. On the x-axis, we have the non-employment index. In this case, the non-employment index based on 1 month's classification, okay? So each dot on the figure represents monthly observation from 1994 onwards. So on y-axis, unemployment, the level of unemployment rate in that month. On x-axis, the level of the non-employment index in that month. Red dots are data from 1994 to July 2007, okay? Then what we do, we estimate linear regression based on the red dots. And that linear regression is plotted as a black line, okay? Then blue dots show data from July 2007 to December 2013. The green dots from 2014 all the way to the most recent observation. And the most recent observation here is February 2016. It's a black dot. You almost don't see it because it's exactly on the black line, okay? So how to interpret this figure? So prior to 2007, there is a linear, almost perfect linear relationship between the unemployment rate and the non-employment index, which is a more comprehensive measure of resources in the labor market. So both measures show the same, give the same information about the degree of underutilized resources in the labor market. Okay? Then the blue dots are above the black line. So what it means, during that period, the unemployment rate is above the black line. So unemployment rate was higher than would have been predicted by the relationship prior to 2007. So unemployment rate during that period shows more slack in the labor market than the non-employment index. And then the green lines are going back closer to the black line. And finally, February 2016, very close on the line, okay? So what we conclude from this figure, we conclude that during 2007, 2013, unemployment rate was showing more slack than the non-employment index, which is more comprehensive measure of resource utilization in the labor market. But now, the unemployment rate shows exactly the same, contains the same information in terms of what is the health of the labor market as our more comprehensive measure of resource utilization. So in simple words, the 5% of the unemployment rate now, it's the same 5% before 2007. Okay. So that's the main idea. And then we do battery of robustness checks when we construct the same graphs, but instead of using the non-employment index, we use non-employment index and add working part-time for economic reasons. And then we construct, instead of non-employment index using 1 month classification, we use 3 months classification. So let me show you just one more graph. So here we have unemployment rate on the y-axis, and on the x-axis, I have non-employment plus part-time for economic reasons. So recently, the Fed has been concerned that those who are working part-time for economic reasons, the number of those in the economy after the recession has been quite large, and it has been rather slow to go down. So there is quite a lot of attention to those workers who would like to work full-time but working part-time. So here, our measure of non-employment index plus part-time for economic reasons shows the same picture as before, that during 2007-2013, unemployment rate overstates the degree of labor market slack, but now we are very close to the relationships that we observed prior to 2007, okay? So if we don't use this non-employment index where we aggregate everyone and where we weight different groups of the non-employed with different weights, this figure would have been very different. So on the left-hand side is the figures that I have just now shown, and on the right-hand side, we have unemployment on the y-axis and U6, the BLS measure on the x-axis, okay? U6 is official those who are officially counted as unemployed, plus marginally attached, plus working part-time for economic reasons. So some selected groups, everyone enters with weight 1. So on the right axis, you see that blue dots and green dots and the black dot from February 2016 is below the line, okay? So what it means? It means that as compared to this broader measure, U6, the unemployment rate underestimates the slack, okay? Because unemployment rate is below the black line as compared to the pre-2007 relationship. But if you go back to the left panel, where you have the non-employment index that takes into account all the non-employed and weights them, then you see that we are back on track, back to the relationships that we had prior to 2007. So that's the main message that we have, that when we use the measures that we argue is more comprehensive measure of the labor market, of the resource utilization in the labor market, it shows that current unemployment rate shows exactly the same relationship that we had pre-2007. And so we have here more robustness, and I'm sure, so let me just conclude. So we construct the non-employment index, which takes into account all non-employed and weights different groups of non-employed by their propensity to become employed. And so we find that prior to 2007 and post-2013, the unemployment rate contains the same information about the health of the labor market as the non-employment index, which is a more comprehensive measure of the health of the labor market. And we update the non-employment index monthly on the Richmond Fed website. Thank you.
Perhaps the obvious one, but this isn't part of what you presented, but do you have a view on what the natural rate is, or the NAIRU? You're saying that the unemployment rate as regularly measured actually gives a fairly reasonable assessment of degree or tightness relative to your other measures, but do you have a sense of where the sustainable lower bound might be? Or is there still excess, in other words?
Thank you. So basically you're asking whether we have a natural rate for our non-employment index. So we haven't taken stand on that. But now we show that the 5% of the unemployment right now is the same 5% of the unemployment that we've seen before 2007. So depending on what you think about 5% unemployment rate, how far it is from the natural rate, I think we can translate it to the non-employment index. but we don't have the natural rate for non-employment index yet. Thank you.
Thank you for a nice report. It's anyway very useful for central banks that are going traditional New Keynesian way. My question is next. You concentrate mostly that traditional unemployment rate overestimates lack on the labor market, but also does it mean that in the same time it means that economy is more flexible than we can expect?
In what sense more flexible?
Flexible, I mean more adaptive to the shocks.
I'm trying to understand what you mean by. I'm trying to understand from going. I'm trying to understand what does it mean more adaptive to the shocks when unemployment. Sorry, I didn't understand. Pardon?
I think
okay.
afterwards you can continue to discuss this issue, given that we have very limited time. Thank you for
okay.
the presentation.
Thank you.
Good afternoon. I want to compliment the organizers for pulling this off. This event is nothing short of extraordinary. I'm quite pleased to be here. And not only I want to thank the organizers for inviting me, I want to thank them for their Spartan's patience with going over all these steps to actually getting me here. And I'm really glad I could make it. So before I proceed with the research I'm going to share with you, let's recall the situation when in Ukraine, lots of people borrowed lots of money in US dollars. Remember that? And then when the crisis hit, when the exchange rate was something like 5 hryvnias per dollar, when the crisis hit, a lot of people were unable or were struggling to pay off the debt in hryvnias when exchange rate is something like 25 hryvnias per dollar, because what they owe is now higher than whatever they borrowed for the value is, all right? So in essence, there was a problem created by debt, by individuals' debt that they either borrowed in a different currency or borrowed too much to be sustainable in the adverse economic conditions. Well, guess what? Something similar happened in the United States. Not exactly, but similar. When the economy was booming prior to the 2007 crisis, lots of people borrowed lots of money. And their debt was related to the value of real estate. When the real estate value dropped, and dropped significantly, same exact worry and trouble emerged. People were struggling or unable to pay for something that is worth less than how much they borrowed, all right? That was associated with the massive waves of foreclosure, defaults, bankruptcies, and then the crisis followed, all right? This crisis set the stage for the Great Recession, and there is a huge body of literature that shows that this overborrowing was triggered, so this overborrowing triggered the recession and the crisis. So before I proceed, though, almost forgot, I have to make this disclaimer that the views are not those of the Federal Reserve System. Here's the chair. Oh my God, I'm not. Chairwoman, are not those of the Federal Reserve Bank of Cleveland. And given the venue we're all here, it's not even those of the National Bank of Ukraine. All right, so I'm trying to click both places so that I can see what I'm talking about, so I can look at you as opposed to the screen. So consumer debt overhang not only triggered all this, triggered the crisis and the recession, there is extensive research that shows that it contributed to the depth of the recession. And if areas that overborrowed more, they actually recovered slower from the recession. So we're blaming all this debt. So there's a big debate. Is it only the monetary policies tool to remedy the situation and bring the economy back on its 2 feet and promote economic growth? Or do we have a little more tools at our disposal here? So we are going to focus on the government spending for this particular research and for this question because we view it as an additional sort of supplemental tool to the monetary policy, and we analyze whether the government can, boost economic growth in addition to the monetary policy tools. So let me start with an example. Let's say the government decides to stimulate the economy in terms of the fiscal policy. Let's say they give me, Yuliya Demyanyk, $1 and say, go ahead and spend it. I will go spend it on the goods and services, and whomever who receives these dollars is going to keep portion of the money for the cost of production of these goods and services, and they're going to go ahead and spend it again. And those who receive this remaining of this dollar are going to keep portion and spend it yet again. So this exact same dollar is being spent multiple times, and it's going to boost economic growth if that's what's happening, because in order to consume, produce, So this phenomenon is called the fiscal multiplier, all right? The fiscal policy or this government spending would only make sense if this fiscal multiplier is more than 1, meaning government spends $1, we all spend it in turn, and we produce more than $1 economic growth. So the question is, all right, so we give Yuliya $1 to go and spend, but if I borrowed pre-crisis, I'm not going to go spend it. I'm going to pay off my debt, okay? So in this sense, if I were to pay off the debt, the old debt that triggered all these problems in the economy, I'm not going to start generating the fiscal multiplier. So in this sense, the policy is going to be ineffective. So we are just going after the question. It's not working. We're going over the, here we go. We're going over the question whether if government spends money in the areas where there is economic trouble that was caused by over-borrowing in the United States, whether this policy is effective or not, whether it leads to multiplier. There's a huge body of economic research out there that measures, that proposes theories of these fiscal multipliers or different measures of them. There are fewer theories that introduce a fact that we as consumers are very different. If I were to receive this dollar, I may or may not pay this debt or may not consume. Other consumers may be in a different economic situation, different family situations, different attitude towards debt or consuming. So the heterogeneity among consumers matters, and there are a few theories that introduce that to measure the impact of the government spending. There are even fewer theories that introduce this debt component into the heterogeneity of consumers and heterogeneity of all these factors. There is, to the best of our knowledge, there's no empirical evidence that actually measures what is actually happening when there is some money coming from the government to the consumers. Do they spend? Do they pay off the debt? And so on. So in this paper, we do exactly that. We just empirically evaluate the impact of government money coming into the smaller geographical areas and their impact and their variability depending on how much debt there was in this country. So we're using a cool data set, and it's from the Department of Defense spending in the United States. In this paper, I probably won't be able to finish it all because I can just, I am not advancing my slides. You know what? Here we go. In this paper, we show that the fiscal multiplier is actually larger in the areas where consumers overborrowed. So not only it's effective, it's more effective. It helps to mitigate the adverse effect of over-levered consumers on the local economy in a certain way. We take a couple of steps further. We are evaluating 3 different mechanisms. How does it work and why does it work? We evaluate the relaxation of the credit constraints, where the people who receive a little more money, they're no longer credit constrained, so they consume more. Whether there's this heterogeneity in the marginal propensity of consume by certain borrowers, and looking at the excess capacity channel, something that Marianna was measuring, the excess capacity in the economy. So we're using the Department of Defense contract level data It was a pain to put it into the data set, but I'm proud that my co-authors did it. We know the amount, the date, the duration, where did the money go, in which area, is it state or is it city, which area of the United States it went. And I gotta tell you, it's United States we're talking about, so it's a massive amount of the military expenditures out there, and it's the third largest expenditure that the government is spending money on, third after Medicaid and the Social Security. So we have all these contracts, one by one. It's a public data, actually. So we have these contracts, and they vary from like $25 disbursement and like $32 billion. So they vary. Some are small, some are large, some are short-lived, some are lasting for some 10 years. So we need to put it in some data sets so we can run some statistical analysis using it. So we break these dates into years, essentially, and we allocate the portion that was actually used in that particular year for the year. This is how we construct the annual data of the government defense. We know where the money go exactly, and the data is very granular, not just the state. I want to show you what is it we use for the variation in our analysis. So the middle line of this chart shows the national military expenditures in the United States as a fraction of GDP. And you can see that these military expenditures is based on the geopolitical events, such as Vietnam War, the first big Soviet invasion of Afghanistan, the second one, and 9/11 here at the end. So the national spending depends exactly on this, on the geopolitical events. However, there's this huge variation in the states or even smaller geographical areas. Let's say California has a huge place where they produce whatever military things they produce. And it's a line on top. And you can see that California, for example, is much more sensitive to let's look at the Vietnam War, the very first drawback, all right? The drawback on the national level was whatever it was, but then 2 times higher was the drawback in California. And 2/3 of that was the drawback on the bottom line, which is the state of Illinois, all right? So we're using this geographical variation for our analysis, and we're gonna say that if the more money comes in, let's say to California, and in certain areas of California there's more or less debt, how did the fiscal multiplier work there or not? Okay? So other data such as unemployment, income, GDP, debt that we use as controls. So this is what we actually do. On top is the equation, and I'm going to show a couple, but they're not going to be really the same, all right? It just differs by the control variables. On the right-hand side of it, you see the measure that is a difference between government spending during and post-crisis. It's going to be 09 and 08, minus the government expenditures pre-crisis, 06 or 07, normalized by the income of that area where the government spending went pre-crisis. So this is the measure that measures essentially the growth of the government spending. On the left-hand side is going to be either income or unemployment or GDP of that particular area constructed similarly, post-crisis minus pre-crisis, normalized by the pre-crisis. The coefficient beta y is the fiscal multiplier, okay? So we're going to measure these things on the county, CBSA, and state level. So the county is a smaller geography, CBSA is the middle one, and the state, you know what the state is in the United States. There's a couple of interesting features that emerge from this table. We see that the multiplier increases by the area that we measure it at, which means if you put money in the small geography, that means government is starting some project. So they are hiring more people or giving people more jobs, right? And if there's a smaller geography, people can commute to get these jobs. So the multiplier looks really, really tiny. When we move to the state level, it's the last column, which I didn't advance the slide. You see the multiplier is larger than 1. So what we're learning from here is if on the state level multiplier is larger than 1, that essentially corresponds to about 0.3 on the CBSA level. It doesn't mean it's less than 1, it's not desired. So it is desired, and we are going to be looking at the CBSA level, which is about third and fourth column. Okay? So first we establish that there is a multiplier, and then we want to see whether this multiplier depends on how much leverage there is pre-crisis, and whether the government spending can mitigate, or it's essentially ineffective if there's a lot of overborrowing. So we're running similar regression, but we're including the interaction of the government spending with the debt-to-income ratio in the geography we're looking at. Okay? So what we found here is that, first of all, if there was a lot of debt pre-crisis, there is a slower economic growth post-crisis. Okay? So everybody grows slower if there is a lot of debt. Second of all, government spending, when it comes to the area, it helps to boost economic growth. However, I'm more interested in this coefficient, meaning if the area had more debt and the government money comes in there, it boosts economic growth. All right? The effect is large. If we compare the geographies that had 25th percentile of debt versus 75th percentile, the difference is like twice as large. All right? It increases the multiplier by 100%. Okay? I'm going to skip this. So evidence so far, the government spending multiplier, it increases in the size of geographic unit because people can commute. Comparable magnitude to the prior literature, so that gives us confidence that our data is good. But most importantly, we see that this government spending multiplier is higher in the geographies with higher household leverage. All right, so fiscal policy would help out us central bankers to promote economic growth, which is something in our dual mandate. So, please work. What mechanisms are responsible for it? So one of the theories is that if consumers overborrowed and now boom, the crisis hit, they have to pay off the debt. To pay off the debt, you have to spend less. So your consumption is going to suffer. All right, so consumption is going to drop. If government spends any money, so they give you the jobs, they give you, there's bigger projects to work on, it can either relax your borrowing constraints, you have a little bit more money, so you're not worried about, postponing your consumption to pay off the debt, you have more money. So it can work through the relaxation of the credit constraint, or it can work through the difference in marginal propensity to consume, which I'm going to cover in a second. Please. We have, for the consumption, we have the ginormous data set. So in the United States, everybody who uses credit enters the credit bureau data. Everybody is assigned a special score called the credit score. In this data set, it's quite beautiful. We know whether people borrow, pay off, how much they spend, how many accounts they have, all that. So there are three main credit bureaus: TransUnion, Equifax, and a third one that's not entered here. It's called Experian. We know everything about how much people borrow and what they do. In TransUnion, we also have people's income. Okay? In Equifax, we don't have income, but it's more randomly selected sample. Okay? So if government spending relaxes individuals' borrowers' constraints, we would see that people actually borrow more when the government money comes into the area. When we here we go. However, we see that the more government money comes into the area, the more people delever, all right? They don't borrow more, which is inconsistent with the relaxation of the borrowing constraint or the credit constraint. So somehow, people pay off the debt, and the fiscal multiplier is still higher. So we're a little bit puzzled. We want to know how is it working, and why do we observe such an effect if people don't borrow more? So they pay off the debt, so they must be consuming more somehow using the government money. What am I showing? I'm totally confused with all my tables. So we see that the government spending does not relax borrowing constraint, but it doesn't have to relax it for everybody. Maybe it's certain people who are only marginally constrained that it helps out, or maybe it's the people who are on the border between cutting the spending and not cutting the spending. We do also, we do a slew of robustness tests and show that the effect is uniform. Thank you. Oops. How about I skip that? No, I won't. So certain people, like let's say more richer people, they wouldn't spend every penny they receive or every dollar they receive from the government for consumption. However, relatively, let's say less rich people, every dollar they receive, they may go ahead and spend it, all right? So we're considering whether there's differences like that, and we don't find anything. I'm going to skip that. So we're also testing whether people consume more. There's no data on consumption. We don't know how much people spend. So we're looking at either how many cars people buy, this is the best data set we have, or what their credit card balances are, what their auto loans is, and what their retail loans are. We don't find anything, to give you a heads up. There is nothing on the credit cards. There is nothing in the overall consumption measures we have. You see there is no significance, nothing in the government multiplying depending on the debt. Let's see what I can do with regards to my time. So I'm going to find you what we do. I'm going to show you what we do find, skipping ahead. We know that there was a consumer debt overhang, well documented. We know that because of it, the aggregate demand fell, and because of it, there was a rise in unemployment, this huge spike that Marianna was showing. Now, the government spending comes into the air in terms of projects or more work, and they have these new job offerings. What can happen if there's not enough slack in the economy? These new governments say, hey, we need to produce more military goods and equipment and whatever it is they produce over there. So that means government needs jobs to be done. If there's no slack, these jobs are going to come out from the private sector, as known as a crowd-out effect. However, if there is excess capacity, when government money comes in, they just hire everybody who is available. There's no crowding out effect, and the economy is growing as a consequence. This is exactly what we find. Hold on. So it's kind of hard. It's kind of hard to measure this because we cannot quite measure excess capacity, even though Marianna had a wonderful index. It's not clear what is excess capacity out there in the economy. Plus, you could use unemployment, but it's endogenous to the local economic conditions. So what we do is a clever trick, in my opinion. We're looking at the sector of the economy that does not benefit from consumption. The story I told you, spend $1, somebody else gets $1, spends it again. In the sector that does not benefit from it. However, it benefits from economic slack. And that industry is the national security and international affairs sector. So this industry definitely doesn't benefit from all this, consumption mechanism. But when the government money comes in, it would benefit from the economic slack. So even in this industry, we find, which I forgot to click, even in this industry, we find that whenever there was more debt prior to the recession and the government spending came into it, we have an increase in the government, in the fiscal multiplier. So In this paper, we found that expansionary fiscal policy, even though there is a worrying debate out there in the literature, is effective in mitigating the adverse effect of debt on economic growth. We don't find much evidence that fiscal policy stimulates economy via the consumption channel, but we found that if there's a debt overhang, lower consumption, lower employment, which means high unemployment. High unemployment is actually good for the government fiscal policy, for the expansionary fiscal policy to work, because it means excess capacity. The money comes in, more people get jobs, there's less crowding out from the private sector, and the expansionary fiscal policy boosts economic growth. Do I have time? I don't have time. So I don't have to show you contribution to the literature, I guess, so thank you very much.
Thank you very much for very extensive and interesting research. And I'm just wondering, is it possible to project the results for other countries? Because, for example, in US, the fiscal policy can be counter-cyclical. Yes, fighting the recession with fiscal stimulus. But, for example, in Ukraine and in Greece and maybe in other European countries, that was not so many room for fiscal stimulus. Instead, because of the crisis events, these countries should go through fiscal consolidation. And in that case, what do you think? This consumer overhang of credit, does it create more problems with with fiscal consolidation, or maybe easier?
You know, as the title suggested, can we cure debt with more debt? Meaning, can you cure consumer debt with the government debt? So, you know, the critics say, well, you definitely cannot create even more debt to create problems caused by debt in the first place. Taking apart the balance sheets of the government of either countries, including US, we show that if you need to fix a problem, this is an effective way to do it. And the very reason why I am about to change the title, I included the second line, which says fiscal stimulus and consumer debt, is because we are actually staying clear from how is the government going to pay the debt type of factor. So these are separate issues that need to be addressed and thought about. However, if the government can deal with the debt and wants to help boost the economy that was suffering from people over-borrowing, this is a way to do it.
Thank you, Yuliya. Very stimulating. Quick question, and I might be confused, most likely. So I think you're focusing in your analysis on the level of leverage, right? You look at debt to income at the point of time. I think it's 2008, but I mean there was a lot of change, you know, at the boom and then at the bust, and that change. There were differences across section, across counties. So those counties that sort of leveraged more, they deleveraged more after during the bust. So I was just wondering if, you know, you should also look at the change maybe you already have, and I mean whether that's material for you.
So what we do is, yes, we're looking at the cross section, but we're looking for after the crisis, well, during 08, 09, but we're looking at the debt prior to the crisis. Meaning, if you over-borrowed, you gotta either pay back afterwards, or borrow more, or somehow you need to stay afloat. So you have to look at the debt prior to the crisis because it's exogenous, first of all, because if you borrowed more, you're going to have to repay back and so on. So how you're going to weather through the crisis depends how much you borrowed before that, right before it happened. Does it answer your question? Okay.
I think we have to stop here. Thank you.
Yay!
Research presentation by Iikka Korhonen of the Bank of Finland.
Okay. I'd like to, of course, also thank the organizers for inviting me. I've been very sort of impressed by the high quality of presentations and discussions, of course. It's a promising first annual conference, and I'm sure that there are many to come. Also a disclaimer, I'm not speaking officially for Bank of Finland or Eurosystem. I don't think Eurosystem has an official view on China. Okay, so my presentation is actually a mix of three different topics, three different papers with various degrees of academic ambition. But all of them look at China and China's relationship with the rest of the world. So first of all, I will look at the Chinese business cycle and its correlation with the rest of the world. What does the literature say? Then I'll look at the possible consequences of China's sort of rebalancing, what would happen to the rest of the world. And then I will try to say something about the possible effects of China opening up its capital account. What could happen to the international capital flows and what could be the potential effects. But first of all, the Chinese business cycle. So this is, if you take the quarterly real GDP and apply the standard Ramos-Seeds seasonal adjustment to it, this is what you get. It's not quite a straight line, but it's actually pretty close. And you can see, for example, the 2009 crisis. Well, there's a slight variation in the angle that the straight line goes up, but otherwise than that, it's really almost impossible to see any effect there. So I guess the first question is, what is the business cycle in China? Then if you look at the growth rates, of course, there is some variation. You can here, of course, see also how in China the growth decelerated from some 14% to 8% during the global financial crisis. Now 8% is of course not bad, but it's significantly less than 14%. So there is some variation in the Chinese growth rate. And then of course it's interesting to think about what is the correlation of this growth, whether measured by GDP growth or industrial production, with the rest of the world. How do other countries sort of correlate with China? Okay, then. So in a paper, actually forthcoming paper, I got the final acceptance email yesterday. A colleague and I did a meta-analysis of all the papers we found, trying to say something about the correlation of business cycle in China with some other countries. So I don't know how many of you are familiar with meta-analysis, but one could perhaps describe it as a sort of more formal way of doing literature survey on a given topic. So here we are interested in what is the correlation of some economic variables in China with the same economic variables in other countries. So basically we go into various paper depositories and with various search terms that you can see here, we look at we collect all the papers dealing with this topic, and all the papers that we have here report correlation coefficients of something, some variable with the same variable in other country. Here I think also the innovation is that, well, first of all, nobody has done this for this particular topic. But then we also collected Chinese language papers on the topic, and actually there are quite a few of them. And when I say we collected, of course, a Chinese PhD student collected them. Then we code them, we look at the correlation coefficients, we report or we collect data on the authors, their affiliations, publication, whether it's in journal, PhD thesis, what kind of control variables are used, and so on. So we try to control everything we can when we are looking at the coefficients. And then we run regressions of this type. Well, first of all, papers report correlation coefficients. Correlation coefficients are bounded between -1 and 1. We do the Fisher transformation to unbound them. So that makes the regressions, I think, more plausible. And as I said, we try to control everything we can code when trying to look at what affects the reported correlation coefficients. People have done this for many different topics, and it's surprising how many things actually correlate with reported findings. I mean, people, not in this topic, but central bankers might differ from people in academia and so on. Okay, in the main sort of analysis of the paper, we use everything, all the different variables that are out there. GDP, industrial production. Some people use the Blanchard-Croix decomposition. They look at the correlation of demand or supply shocks. But here I'm showing you the GDP growth rate correlations, because they are, of course, perhaps the sort of most intuitive in a way. And correlation coefficients are actually pretty high when you are controlling for everything else in the papers. It's not surprising that say Taiwan or Hong Kong have high correlation coefficient with China, but even US almost 27%. So I think that's pretty high. I mean, a priori, I don't know if I would have expected such a high correlation coefficient. What's surprising is that we don't find anything for Japan. We really have checked through this, but that's true. Smaller Asian countries, countries like Laos, Vietnam, Myanmar, very high correlation coefficients. But of course, when you think about and look at the trade flows, again, this is not very surprising. These countries are often part of the same sort of production networks that China and Chinese companies are. Then you have countries like New Zealand, again, producing a lot of stuff for Chinese markets, very high correlation. Okay, that's the first set of, so the first part of my presentation. Then I'm going to the second part. What happens if and when China rebalances from its very sort of investment-heavy, investment-led growth model to a more consumption-based growth? You can see that perhaps some of this is happening, but obviously investment ratio is still extremely high, around 45%. I don't think that's sustainable even in the medium run, so something needs to happen. So a colleague of mine basically did, she took data from the OECD trading value added, and then combined that with the national input-output tables. And it did a very, in a way, simple but fairly sort of computationally heavy thought experiment. What would happen if China, the composition of China's GDP growth, or GDP, would change? What would happen to Chinese imports, and how that change in imports would translate into GDP or output developments in the rest of the world? And then we have two scenarios. So there's a hard landing where China just rebalances. So there's a 5 percentage point change in the composition of GDP. So consumption goes up, the share of consumption goes up by 5 percentage points, and investment cost comes down by the corresponding amount. And then there's just the gradual rebalancing scenario where that rebalancing is just 1 percentage point, and at the same time the overall Chinese GDP expands by 5%. I think that's probably the more realistic scenario. And you can see that in the sort of hard landing scenario, the imports in the right-hand side panel, anything related to mining, manufacturing goes down, and also total imports go down. So the rest of the world will suffer in that sense. If there is this sort of more benign rebalancing scenario where China continues to grow, okay, the blue bars, everything, imports do grow, but of course, different sectors do differently. So if Chinese consumers are more affluent, they will require more different, better food. So all the countries that are actually exporting food stuff will benefit. They will require more services, they will require more textiles, for example. But then everything related to construction, mining, so on, will suffer. Oops, sorry. Okay, so this is then the country breakdown in the output in these two different scenarios. You can see that in the sort of more benign rebalancing scenario, if China grows, then everybody is better off, but some countries are better off than others. So East Asia is very linked to China. It benefits. Countries like Australia, exporting a lot of not just hard commodities but also food stuff, would benefit on the net. Countries like Brazil, of course, a lot of people are talking about how Brazilian economy is suffering from sort of rebalancing of China. Well, in this exercise, well, Brazil would export less, say, fuels, but much more food stuff. So on the net, actually Brazil would, even in the hard landing scenario, Brazil would not suffer. Okay, then the finance channel. Well, first of all, China is still financially relatively closed. Capital account has been liberalized somewhat during the past, sort of recent past, but nevertheless, it looks like some sort of contagion from China and Chinese stock markets has really had an effect on the rest of the world, at least during the past few months. I'm just showing you here the VIX index as some sort of metric of risk aversion in the global economy. And you can see that in last September, August, when the Shanghai Stock Exchange collapsed almost 10% in one day. You can see the effect on VIX. So the global uncertainty, risk aversion shot up significantly. And the effects were immediate in the other stock markets, first in Asia, then in Europe and in the US. And you could really see the effects also, especially in the currencies of the other Asian countries. And just by sort of way of comparison, you can see that the VIX had peaks, for example, during the Greek referendum, and that was significant. But whatever happened because of the Shanghai Stock Exchange is sort of several times higher or more important in this sense than the Greek referendum, for example. And I think this is actually somewhat puzzling, given how closed the Chinese financial markets are. So perhaps the investors seeing this thought that their expectations about Chinese economy were now somehow completely wrong, and they reassessed very, very quickly, and then everything sort of fell apart, at least for a while. But that this is a real sort of potential avenue of influence from China to the rest of the world. Actually, the sort of tying the previous scenario together, colleagues, some people at ECB did a sort of similar exercise where they looked at the trade channel and then they sort of put in the model also this uncertainty shock. And the trade channel itself didn't give you much in a way of effect on the rest of the world. But if you have a sort of uncertainty shock like this, and especially if it persists, then actually those effects are much larger than the pure trade effects. So somehow, even despite the relative closeness of Chinese financial market, effects from there can have real effects on the rest of us. And then the last part of my presentation is basically trying to think about the eventual liberalization of Chinese capital markets or capital account. So in the latest 5-year plan, I think this is the 13th plan, or 13th, I think the Soviet Union had 13, so soon China will have a 14th and will sort of top up or have one over Soviet Union. The 5-year plan says that by 2020 capital account should be liberalized, but this doesn't mean completely liberalized. Short-term debt capital will remain controlled. So in a project, I basically just looked at what happened to international investment position of different countries before and after they liberalized. So here in this first chart, I'm showing you, so 15 years before and 15 years after, a bunch of OECD countries, when they liberalized, how the stocks of both foreign assets and foreign liabilities behaved afterwards. So you can see that, of course, the net foreign asset position of these countries, on average, was close to zero, and that's to expect it, because if you have a lot of countries, then their assets and liabilities cancel each other out. But the gross stocks, assets and liabilities, can be very large, 200–300% of GDP, and that's quite a lot. When you do a similar exercise for some emerging market countries, well, first of all, the gross stocks, even 15 years after the liberalization, are much smaller. On average, well, less than 100% of GDP, but still fairly large. So now if we think that China in 2 or 3 years' time would completely liberalize, so it would arrive at year 0 in this liberalization time, how does China compare with other emerging market countries that liberalized before? Well, you can see that there are some similarities. So the total liabilities, total foreign liabilities of China are more or less the same. But the composition of assets and the size of the assets, gross assets, is very different. So China has much more foreign assets than other emerging market countries did before they liberalized. And especially China has much more official assets, i.e. currency reserves. So that's the sort of first observation. If China liberalizes, then perhaps at least the relative size of the currency reserves could change. But then when one goes a bit deeper into different sort of subcategories of these stocks, assets and liabilities, then China is an outlier in some respect. Because of the way capital account has been sort of closed off, the rest of the world holds very little Chinese debt. I mean, the rest of the world has invested a lot into China in foreign direct investment, but we have very little Chinese debt assets. So somehow, I mean, Chinese have kept foreigners out of their debt market. And the size of this difference, even to the other emerging market countries, is very big. So if and when China liberalizes, the portfolio shifts globally will be very large. So there will be a lot of money, a lot of capital flowing out of China, and I think partially that is already happening. But then, on the other hand, there will be a lot of money flowing into China, into different Chinese assets, and that process has not really started yet. So what the net effect is, I have no idea, but it's clear that there will be a lot of sort of portfolio rebalancing taking place, and a lot of the relative prices will change. Okay, I'll conclude here. Just basically, China is very correlated with the rest of the world, even with countries like US. There's a lot of trade, and of course a lot of the correlation comes from trade, but I think more and more now China, even if it hasn't really opened up its capital account yet, somehow the Chinese financial markets are already affecting us. And if and when the capital account liberalization goes forward, then I think that effect obviously will only increase in the future. I think I'll stop there, and happy to take any questions. Thanks.
I apologize for asking another question, but I'm interested. I may have missed something, but you've got correlations. But if you believe China's growth was driven largely by exports, is it that our GDP is driven by theirs? You'd think it'd work in reverse, that their correlation and growth, to the extent it relied on exports, was only because of our growth. Now that could change in the future, but if their exports were so much larger than their imports, it isn't clear.
Well,
their GDP growth actually provides a reliable measure of any net stimulus. In fact, on net, they were taking from the rest of the world. No?
Well, I'm not totally convinced that the Chinese growth, especially during the past 10 years, it has really been about exports. I mean, if you just look at the value added in net exports, that's actually a very, very small portion of Chinese GDP. I think it's mostly been about domestic, especially investment. Yeah.
Anybody else? If not, then I would like to thank you.
Thanks.